right, picking back up where we left off, let's now talk about the buildings account. Again, we're keeping separate accounts for the types of PPE that the company actually has. So on the balance sheet, while the category might say property, plant, and equipment, the distinct rows or items are going to be listed in separate accounts. So here we are, we finally made it to buildings. If you get your yellow sheet out, you should see a line for buildings already there, and we know it's an asset and we know it's listed on the balance sheet. But here in this particular chapter, we're now going to start using the buildings contra asset account, and it's going to be called accumulated depreciation hyphen buildings. So land improvements has its own, buildings has its own, and equipment will have its own. All right, so buildings is the asset, and then the accumulated depreciation hyphen buildings is buildings contra asset account. So if we were going to calculate buildings comma net, like we have done in the earlier in the semester for equipment comma net, what would you all do? You would be taking buildings minus the accumulated depreciation hyphen buildings number to get buildings comma net. So we had spoken earlier about this historical cost concept. What is the number that we're originally going to increase the buildings account by? Well, we've got to sit down and typically add up several numbers, just like we had to add up on the land, to come up with that total dollar amount to increase that buildings account by. So again, we're talking about including all the cost related directly to the purchase or construction on the building. And we're talking very specifically about getting the building ready for its intended use. All right, so what if we purchased a building that was kind of needed a little work before we could move in and use it for whatever our intended purpose is? What if we were a restaurant and maybe it needed some paint and it needed a new floor and the bathroom needed to be remodeled and the kitchen needed some work? Okay, some of those construction costs are going to be helping us getting it ready for its intended use. What if we're building a brand new building? Well, we've got all kinds of costs that need to be rolled into the total that we would be increasing buildings by. Okay, so if we're talking about purchase cost, we're straight up buying a building. When we go to the closing table, just like when we talked about the land purchase, we are going to be looking at the purchase price plus any other costs that we have to incur in order to buy the building. These may be the closing cost at the closing table, which can include things such as the attorney's fees, the title insurance, the title search, maybe some recording fees at the courthouse. Things like that all need to get added up, as well as any real estate agent fees. And then if we've got other expenses that we are going to have to incur, or costs that we are going to have to incur to get the building ready for its intended use, like remodeling or replacing or repairing certain aspects of it, we would roll those numbers in to this total, because this total is the number we need to use when we calculate our depreciation items. Okay, so add all those numbers up, and that's what you're going to increase the buildings account by. And then let's just say we are paying cash for it. We would decrease cash. What if we're constructing a building? Well, we're talking about just the building part. Okay, the land is a separate account. So don't try to include your land stuff in with your building stuff. For the building, we are talking about everything it takes to get this building built. We've got to pay architects to draw it up. We've got to go and draw permits from the city or the county or both in order to be able to build the actual building. We may have to have David Hoover come back and excavate the top of the lot where we're going to build the building, and it's got to be graded to a certain degree, and maybe some rock work and whatever. All those kinds of things have to do with the building getting built, and we're going to capture that in the building account. So we would need to add all those items up if we are doing construction cost. Okay, in addition to what it actually costs to build the building, the materials and stuff, it's going to be a huge number that gets added up if we're building constructing an actual building. Something to make a note on: when we're building a building, oftentimes we are borrowing money from the bank to do this. And if that's the case, there's interest accruing on this borrowing as we're using the money. During the period of construction, those interest costs during the period of construction are also going to get added up and rolled into this total dollar amount that we are going to increase the building account by, up to the date of what is called occupancy. So as soon as somebody from the county or the city comes and evaluates the safety and is everything up to code and gives us a certificate of occupancy, basically saying, yes, it is okay for you to move in and start using this building, up to that date, those interest costs are going to get rolled into the building account dollar amount. Any interest cost on that loan after the fact are going to get treated as regular interest expense. But for right now, they're going to get rolled into the construction cost. All right, moving on to the next slide. If we're talking about equipment purchases, for example, if Southern Tool Steel was going to go buy one of those big, huge saws, we would have a lot of things that we would have to roll into this total dollar amount. Not only is it the cash purchase price for the saw, which is a piece of equipment or machinery, we would also have to roll into that number the amount of sales tax we pay on that saw, any dollar amount for freight that we've had to pay to get the saw delivered. For example, one of our saw vendors was in Ohio. We would literally have to pay for an 18-wheeler to haul that thing from Ohio to Tennessee. We would also be paying insurance on that saw while it's in transit. So in other words, if they have some type of major accident and something gets damaged on the saw, that we would be able to recoup some insurance there and buy another saw. So insurance cost, freight charges get rolled in. Not only that, but again, think about what I've said, getting it ready for its intended use. Well, how would we get our facility ready to even be able to place that saw on the floor in our building? We may have to pour an extra thick concrete pad. We may have to assemble part of it. We may have to have some special electrical wiring ran. Maybe have to have an engineer be flown out to install it, test it, etc. Whatever it takes for us to get that saw ready for its intended use, all of those numbers are going to get added up, increase the equipment account by that, and then we will use that total dollar amount in our calculations for depreciation, which we will get to here shortly. All right, so we've got an example. Leonard Company purchases a delivery truck at a cash price of $22,000. In addition to the $22,000, they also have sales tax on the truck of $1,320. They also pay for painting and lettering on the truck. So, if it's going to be wrapped or the company name and phone number and website put on the doors, that kind of thing, $500. The company is also going to be paying for a motor vehicle license, $80, and then a 3-year accident insurance policy is also being purchased at this time for $1,600. Now, as you guys know, throughout this semester, we have had some TMI, or too much information, occasionally given to us, which is what happens out there in the real world, and we have to decipher how to use that information. So on this particular one, right now what we're trying to figure out is how are we going to put the total to the equipment account for the purchase of this truck. Well, some of these numbers we need and some of these numbers we don't need for that total to equipment. The cash price of $22,000, definitely need that. The sales tax of $1,320, definitely need that. And then the painting and lettering, the $500, we're going to include that number too. Because if you can think about it, that $500 expenditure right there is really going to be helping us for several years as that truck is driven around town. Okay, so roll those three numbers together for a total of $23,820, and that's what we would increase to the equipment account. Now, what would we do with these other items? Well, let's take a look at them. Notice that it says motor vehicle license $80. That's like you guys paying for your annual tag fee for your vehicle. That dollar amount right there is only helping us for 1 year. So that is one of those revenue expenditure type items right there. We could maybe put that to, tag, license, fee, expense account or something to that effect. I'll see what Wiley's given us as an example on the next slide here in a moment. But that $80 is not going to get rolled in to the equipment account because it's only helping us for this 1 year. Same thing with the 3 years of accident insurance policy of $1,600. You guys know what to do with that. You're supposed to put that $1,600 to prepaid insurance. And then every single month, we would adjust that down by 1 out of 36. So $1,600 divided by 36 months, whatever that equates to, you would make an adjusting entry and bring that prepaid insurance dollar amount down. At the same time, you would recognize insurance expense by increasing insurance expense like we've learned how to do. Alright, so here they're showing us on this particular PowerPoint, we've got the total amounts here that are, I'm going to have to adjust my PowerPoints on this, so y'all bear with me just a second. Alright, so on this particular PowerPoint, I'm unable to fix my Zoom for the moment, but if you're looking at your PowerPoints while you're listening to these, you guys can notice that your cash is going down by the total of $25,500, which is the total amount of all of these things added up because it's literally coming out of your cash right now. But what you're recording to equipment is only the $23,820, while prepaid insurance is getting the increase of $1,600, and then you are recognizing the expense of that motor vehicle license to the tune of $80. Okay, so if you're asked to do a journal entry, you are decreasing cash by $25,500. You're increasing prepaid insurance by $1,600. You're increasing equipment by $23,820. And you are increasing an expense account by $80. Even though what you will end up doing is subtracting $80 as an expense on your income statement for this same period of time. Alright, so what we have been discussing is what we are doing with these amounts throughout the period. Alright, so we've now talked about this capitalization or capital expenditures of our assets. So when we replace those saw blades like I mentioned to you earlier, and we said revenue expenditure instead of capital expenditure. Those saw blades are kind of like an ordinary ongoing type of expense that a company may have. There can be other types of ordinary repairs and maintenance that a company may have during a period of time. All right, so we would call those ordinary repairs, and they are for expenditures required or incurred that we have in order to maintain the operating efficiency and productive life of a particular piece of property, plant, or equipment. Again, we're going to just expense these ongoing kind of things out. All right, so you guys would increase maintenance and repairs expense, maybe decrease cash if you're paying it right then and there, or if you're charging it on account and you're going to pay it later, you would increase accounts payable. Like I mentioned, we could also have some type of major spending in order to increase the capacity or extend the useful life of a piece of property, plant, or equipment. And when we have that kind of expense going on, we would call that an addition or an improvement. Again, these are capital investments, capital expenditures. We're adding to the PPE in some way, shape, or form in order to get more utilization out of it. And what we do is take that dollar amount and increase that existing asset in the books, and then we'll recalculate our depreciation going forward. And I will be showing you guys how to do these depreciation items later in our content.